there's enough deals to go around that you don't need to hurry and get into a bad one. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer, and I've got another solo. I'm going to be talking about some things that I see in the market that are happening. Look, as you as an LP or you as a GP, we got to be careful. So I've talked about this quite a bit on social media. I've had some episodes regarding this as well, but I want to dive a little deeper into a deal that I saw. And I was actually just on Bigger Pockets the other day, and there was a link to this Twitter feed following a deal. And I don't know this person at all, the Twitter person, but what they did is they analyzed a deal from a sponsor, a fairly well-known sponsor. They analyzed their deal and they just dug in and poked some holes into it. Poked, quite frankly, a lot of holes into it. Sounds like they don't really like the sponsor, but that's okay. I'm going to go through. I thought not even the validity of the holes they poked into it, because quite frankly, I didn't analyze this. I don't know if they're just being too hard on the deal. I did do a little bit of due diligence, so some of this stuff actually sounds pretty legit that they came up with, but this is not my analysis. But the reason I'm doing this, not because it's my analysis, but because I think it's really important for you to think of as a sponsor that's bringing a deal to investors, as a capital raiser that's doing a fund of fund that's bringing a deal to your investors, or as an investor yourself, right? And you've got to think of these things. So I'm going to run through this deal. It is an apartment complex in the Dallas Fort Worth area, and it was purchased for $55.8 million, and that's the all-in purchase price, by the way. So that's the purchase plus the reserves, plus the renovation capital, plus the acquisition fee, closing costs, et cetera, et cetera, et cetera. So the all-in cost is $55.8 million. That's a really important number to know, because they talk about their basis being like 130 a door. But then when you add all the extra costs on there, it's much, much greater than that. So you have to understand what your true basis is. And if you're telling investors that your basis is much less than what it actually is, like, okay, our purchase basis might be that, but what's our all-in basis? That's a really important number to actually be aware of and actually be disclosing to investors, in my opinion, and making sure that you're not trying to confuse investors with the lower basis than what you really have. So that would actually be red flag number one. So red flag number two is the area. And I did confirm this, and I confirmed a couple other things. So the area they disclosed, and quite frankly, I did not confirm that they actually disclosed this as an A+ area, but I'm just assuming because this person looked at their deal deck and said they disclosed it as an A+ area. So A+ area, they said this was in. It's actually a B class area, and a B to B- area, in fact. The household income is $77,000, and the average home price in the area is about $250,000. The other thing is the population is declining. That sounds weird for Dallas Fort Worth area, but it's true. It's a small submarket. Now, if we zoom out even farther, that's not true. But as we zoom into a 5-mile radius, people are actually moving out of that little submarket. And if you zoom out farther and farther and farther, then it's of course growing, because it's Dallas, and Fort Worth is a growing market. So this is a B class, B-, and it's trending downward. It looks like, not trending upward. So that's a red flag. If you're calling it an A class area, A to A+ area, and it's a B-, not a good look, right? Look, household income 77,000. Not that that's poor by any means, but that's not A class. 25% discount is what they claim to have. There's nothing inherently wrong with saying that, but the way that it was portrayed, at least according to this person, was that they're getting the smoking deal because they're paying 25% less than what the market would have bared just a couple of years ago. Well, yeah, that's where we're at today. And so if you're paying less than that, if you're getting like a 5% discount or a 10% discount, then you're vastly overpaying for the property. You better be getting close to a 25% discount, maybe even greater than that, depending on what's going on. This one, again, not huge, but I think it's something to be looking for, is what are you getting for return on your renovations? And this person, this group is getting 12% return on their renovations. So their rent is only increasing by, I think it was $160 per month, and their cost of renovation is $1,650. So that's not a big margin. I'd like to see 15 to 20% on that. And this, it could be okay. So it's hard to just pinpoint on one thing and go 16,500. If we're getting that, it's a terrible deal because we're only getting this 12% on the rent increase. But if we're also decreasing expenses by renovating, maybe we're doing some things that are going to make it more energy efficient and can save some expense cost, it could actually be okay. So all by itself, it sounds like a bad return, 12%, but in reality, it could be better. I'll give them the benefit of the doubt right now because I haven't dug in that maybe there's some other expense gains that they can get, and they could actually get a 15 to 20% on their rentals. Maybe. Okay. 3% rent growth is what they're calculating. That actually doesn't bother me too much, but what does bother me is they're showing 3% in year one when reality is in that market, it's a negative market right now. And so rents are actually declining. So if you're showing 3% rent growth in year one, you're already behind the ball. And in year two, you're really just telling your investors that you can get 3% when the market is proving you otherwise. So why lie to your investors up front? Now, if you can get an average of 3% over the 5 years, if you told me that, I could believe it, quite frankly, because it's in Dallas Fort Worth. Maybe not the submarket, quite frankly, but the Dallas Fort Worth, if you're saying, hey, over the next 5 years, I bet we're going to average 3%, I wouldn't argue with you on that one. But the problem is year one, year two are likely going to be less. Year three, maybe we hit that, 2 to 3%. Year four and year five, maybe we hit that 4 to 5%. Okay. But that's not what they're showing. This one's the biggest red flag. This one is huge. So I want to dive in. Okay. They are buying this on a 4.9 cap, kind of. Okay. They're saying we're buying it on a 4.9. Well, that's based on the T3 only. T12 shows that they're buying it at like a 4.3 cap. And they're not taking into consideration the increased expenses of taxes, of insurance. They're not putting the replacement reserve in there. So they're really buying it for around a 4 cap. Okay, so they're overpaying for the property. This submarket, and I did confirm this, the submarket is selling for about a 6 cap. 5 3/4 to 6 1/4 in this submarket right now today. Okay. At the peak of the market, this was selling for around a 5.5 cap. Okay. 5 1/4 to 5.5 cap. So the market, the cap rate has expanded, but here's the biggest problem. In 5 years, this group is saying that it's going to sell for a 4.8 cap. 4.8 cap. And so what they're saying is that 120 basis points are going to erode off the cap rate. So we're going to compress the cap rate by 120 basis points. That is very hard to believe that it'll happen in 5 years. It could, it certainly could, but it's hard to believe. Here's the difference. Okay. I told you earlier, 55.8 million is what their all-in number is right now. 55.8 million. At a 4.8 exit, 4.8 cap exit, based on their NOI, which may or may not be aggressive, according to the person posting it, is aggressive, and they don't think they can get there. But based on their NOI, they would sell at $67.1 million at a 4.8 exit. Okay. Based on today's cap rate of a 6 cap. Okay. So conservative would say we're going to take today's cap rate, we're going to add about 50 basis points of expansion to it. So it'd be a 6.5. I gave them the benefit of the doubt. I said, look, cap rates aren't going to expand, but they're not going to contract. They're going to do nothing. They're going to stay at a 6 cap. So based on a 6 cap, in 5 years, the property is worth $53.6 million. Meaning, by the way, you're going to have to pay broker fees. You're going to have to pay some closing costs. So you're going to, spend about, I don't know, $1 million or so. So really, they're going to be losing about $3 million at the sale. $3 million at the sale is what they're going to lose. Now, if somehow they can get that 4.8 cap, they sell it for $67 million. They have, so 53.6 million is a 6 cap. Again, you got some closing expenses, you got the loss of about $3 million. They have a $15 million difference between the today's cap rates and quote unquote the future cap rates. They're projecting selling this based on a per unit basis at what you can actually build it for today, the cost to build. So really hard to believe for 1980s product. They're saying this total square footage is 713 square feet per unit on average, which is really small, quite frankly. So huge red flag there. So really big thing to look at. And by the way, as an investor, as an LP investor, as a GP, as a fund of funds manager, it's really easy to find out what the cap rate is in a market. There's brokers out there, there's appraisers out there, there are lenders out there. Look, you can easily get that information. Just ask for a CoStar report. Just ask the broker, hey, broker, look, we're looking at a property in such and such neighborhood. And by the way, make sure that's the actual neighborhood, but we're looking at a property in such and such neighborhood. What's for a stabilized property? What's about the cap rate today? And they should be able to tell you a pretty tight range, 5.75 to 6.25 cap. Okay. Just figure that out. It doesn't take that much work. You can get it figured out if the sponsor doesn't have that information for you. If they have a CoStar report already, just make sure that CoStar report reflects the proper information. Okay. Are the like kind of properties that are on that report showing, 80s built product? Is it showing product in the same neighborhood? If it's separated by a railroad track, a freeway, something major, if it's super far away, it's not a like kind property. We should have something pretty close by that is sold that we can point to that says, okay, yep, this is selling at a 4.8 cap. Like that's legit. Okay. So really easy to do that due diligence, really easy to check, in my opinion, if it's an A class, B class, or C class area. Household income, just figure out what the household income is in the area. If you're under 100K, it's not an A class area. Okay. It's just not. It's B class or worse, depending on how low we get, right? The last red flag, and this one is tricky, but the last red flag is $3.6 million they put for reserves. But the biggest thing that I don't like about this is that a vast majority of the money of those reserves are paying for negative cash flow, yet they're telling the story that they're actually making cash flow. And so that's what I don't like about it. And I don't know how this was presented. So the challenge is I'm interpreting what the post put on Twitter versus actually what the sponsor said. So the sponsor could be just totally good in this realm, but if it reads that we're cash flowing and we're paying our investors preferred return through cash flow, then it's not a good situation. If this is reading or we're telling the investors, look, we're raising this extra capital in reserves, and as things go right and we don't need it, we will end up returning it back to investors as a return of capital. That's totally fine with that. But watch out for how much reserves they have, and the cash flow. Is it actual cash flow, or is it just return of your capital in the mask or guise of capital cash flow? Okay. So there's a big difference there. We want actual cash flow on the property. or we want full disclosure at what's going on with that property. So just make sure you understand where that money's coming from. The last thing, and I wouldn't call this necessarily a red flag, but when we put it all together, maybe it's a red flag because we already have these other kind of big risks involved. This is bridge debt, short-term bridge debt, floating rate loan. They're basing everything on the market, interest rates going down and the market behaving really, really well. And so that just puts another layer of risk on the table. If this was fixed rate debt or if we're buying it straight cash, there's just a lot less risk on the table on an already risky deal. And so when we add another layer of risk, which is bridge debt, now we've got even more risk on the table of this deal. So in my opinion, if I were to rate this deal, is it risky or is it not? I would give this, as far as like the highest amount of risk being the highest number, this would be probably a close to a 10 out of 10. Like this is one of the riskier deals, being able to get your money back. Maybe not quite because it doesn't sound like they're doing massive renovation, but this is a pretty risky deal in my opinion to be able to actually retain your capital or make money on your capital. As far as protecting your capital, I give them $100,000. Will I get my $100,000 back? I would say this deal smells okay there. Like I'll probably get my money back. I probably won't make any money. And I might lose some, but if I lose some, it's not going to be all of it. So maybe I should downgrade that risk to maybe like a 8.5, right? Be careful out there. There's a lot of good deals. There are a lot of good deals out there that are happening, that are going to continue to happen. There's a lot of good sponsors out there that are presenting good deals. But just because a sponsor that you like presents you a good deal doesn't mean that the next deal is going to be a good deal too. Do your homework on every single deal. Make sure they're good. Make sure they're doing what they say they're going to be doing. And do the homework yourself. You're only to blame if you get yourself into a bad deal. You're only to blame if you raise money for a bad deal. So make sure you're doing your due diligence. Make sure you're spending time and effort on this and check the boxes to say, hey, this deal works for me. This deal works for my strategy and my business plan as well. I think that's really important. I see a lot of people that want to get into deals. They like the cash flow. They like real estate because it's long-term cash flow and all this stuff. And then they go and get into a deal that's a flip. Well, does that actually make sense? Probably not. So understand what your investing strategy is and stick to that. There's enough deals to go around that you don't need to hurry and get into a bad one. All right. Hopefully that helps you. There's plenty of things to look out for. Like I said, there's plenty of great deals. We're excited about the market, where it's going and where it's heading. We're being super patient out there. The smartest people I know are being extremely patient out there, which gives me a little bit of, okay, maybe we're not so far off. And when you see deals being presented on social media and you hear about deals closing, you get anxious. You say, I want to get a deal done. I want to get something through the door. Man, we're failing. But then you got to slow down and go, okay, are these actually real good deals? Or are these deals that we just like, they don't make sense, right? And that's, I think, a lot of what's happening today. There's anxious people out there that are trying to shove deals in and they don't actually fit. Not saying all of them, right? Certainly. So just be patient. And I feel like the smartest money right now is being very patient, very cautious, and they understand that deals will come and that they can, the patient people will do well and will last a long time. All right. That's it. I'm signing off. Make every day a Saturday. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. But your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So The other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.